the appreciation is depreciating. No. $1.
SoFi short interest has been growing rapidly since the start of the year. Nasdaq data shows that there are over 144 million shorted SoFi shares as of April 29th of this year. That is almost 128.54% up from its December 31, 2021 record of short interest. Could this be a potential short squeeze in the making? Short sellers, specifically SoFi short sellers, have been having a good time lately. But could that good time be coming to an end? What are the odds of a short squeeze happening, and what would it take? Is Wallstreetbets eyeing SoFi stock? Well, according to the Motley Fool, companies with 25% to 30% of their shares being sold are prime candidates for a short squeeze. SoFi is currently on the cusp of short squeeze territory, sitting pretty at 22.46% short close to that 25 to 30%. We're not financial advisors, and none of this is financial advice, so always do your own due diligence. To add more fire to the flame, some Redditors and SoFi investors have been posting about it in Wallstreetbets, which is the same group that pulled off the GameStop short squeeze. The latest Benzinga list of most shorted stocks includes the Fintech juggernaut SoFi with a current short interest of 22.82% as of May 24, 2022. SoFi is not the only one though. All of these fintechs are being heavily shorted. Alongside SoFi are other fintech companies that have dramatically increased short interest. Upstart, one of SoFi's peers in the fintech industry, has it even worse. According to Benzinga, the company has 30.48% current short interest. The fintech company that currently has the biggest short interest, according to Benzinga's data, is none other than the insurance tech company Lemonade, which is 38.19% short. This could, however, be a perfect opportunity for the shorts to get squeezed after all. Indian American investor Mohnish Pobrai once said,
"There's no point making bets where the highest upside is a double and the highest downside is that you're out of the game. I shall go to my grave without ever having shorted a stock, and I think you should do the same."
And the thing with shorting a stock is that it comes with a lot of risk, as nobody really knows what will happen in the market. For one, shorting a stock requires an upfront payment called initial margin requirement. And because investors borrow stocks from brokers, it also comes with interest that, according to Seeking Alpha, typically ranges from 0.3% to 3% per year, and fees are applied on a daily basis. One thing to take into consideration though is that with interest rates rising and cost of borrowing going up, how will this affect short sellers who are using margin to short? Could the increasing cost to borrow capital lead to short sellers packing their things and leaving? We definitely think this could have an effect. But let's see what Peter Lynch has to say about volatility.
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept onto it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola, and I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it.
The great Peter Lynch also suggests to learn from history. He says you need to know the market is going to go down sometimes, and if you're not ready for that, you shouldn't own stocks.
From history is the market goes down. It goes down a lot. The math is simple. There's been 93 years of century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks.
Well, there you have it, folks. The GOAT has spoken. Shorts, as the name suggests, will only be here to pull the stock down for a short period of time. In our opinion, long-term companies with great fundamentals and great business strategy like Sofi will always thrive no matter what the market situation is. However, should Sofi's short interest rise into the 25 to 30% range, it could start gaining some attention from the Wallstreetbets community, and well, when life gives you lemons, you short squeeze. As Ben Graham once said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. If you haven't already, make sure to follow us on our social media pages at Wealth Gambit. The link will be in the description box below. A special shout out to everyone in our Patreon community. You guys truly help to make these videos possible, and we really appreciate all the support. Shout out to Arthur Magazu, Wei Chu, Pietro Serra, Daniel Corbett, Mr. Welfare, Casey Patel, Jeff Sherman, Gregory Villar, Bo Park, Denzel, Shonda, Reginald Davis, Les Broadway, Christian Cardelphi, Kevin Beaufriend, and Jay Bone. We're trying to hit 4,000 subscribers by the end of the month, and we're currently at 3,900. So if you happen to gain any value from our content, please subscribe to our channel, and don't forget to hit that notification bell so you'll be updated whenever we drop a new video. Thanks for watching. We greatly appreciate it, and until next time, peace.